Do you feel like your savings just aren't keeping up with the rising cost of living? With inflation impacting almost every part of our daily lives, protecting your hard-earned money has never been more important. But what if there was a way to keep your wealth safe and even grow it in the face of inflation? In 2026, traditional savings aren't enough to shield you from the economic forces at play. That's why in today's video, I'm sharing the top 8 strategies to protect your money from inflation and ensure that your wealth stays secure and continues to grow despite rising prices. Stick around, because these techniques are game changers. 1. Prioritize Series I savings bonds, I-bonds. As inflation continues to soar in 2026, many are turning to U.S. Treasury bonds for protection. Series I savings bonds, or I-bonds, are one of the best ways to safeguard your money. These bonds are specifically designed to protect against inflation by offering a composite rate. The rate combines a fixed interest rate with an inflation adjustment that is updated every 6 months based on the Consumer Price Index, CPI. I-bonds are incredibly popular for a good reason. They offer a guaranteed return that keeps pace with inflation, so your purchasing power doesn't erode over time. As of early 2026, I-bonds issued through April offer a total composite yield of 4.03%, which is higher than many traditional savings accounts or other fixed-income investments. The real beauty of I-bonds lies in their simplicity and reliability. You don't have to worry about fluctuating stock markets or other volatile investments. Plus, the U.S. government backs these bonds, making them one of the safest options to hedge against inflation. 2. Diversify with tokenized real-world assets, RWAs. In 2026, a new frontier has opened up in the world of finance: tokenized real-world assets, RWAs. These assets are physical items, such as real estate, gold, or even private credit, that are now available for purchase as digital shares. By tokenizing these assets, investors can buy fractional ownership, allowing them to gain exposure to tangible assets without having to invest in the entire physical property. Tokenized RWAs are a powerful way to diversify your portfolio and protect your wealth from inflation. Unlike paper currencies that lose value due to inflationary pressures, these physical assets maintain their intrinsic value. Real estate, for example, historically increases in value over time, and gold remains a trusted hedge against inflation. Tokenized RWAs allow you to trade these assets 24/7 on regulated platforms, making it easy to buy and sell as needed. The key advantage of tokenized RWAs is that they offer inflation-adjusted returns. By holding a portion of your wealth in these digital shares, you can keep up with or even outperform inflation. This strategy gives you access to a global market of assets and protects your wealth by holding tangible, real-world items that are less susceptible to currency devaluation. 3. Leverage Treasury inflation-protected securities. Tips. Another solid option to protect your money from inflation is through Treasury inflation-protected securities, or TIPS. TIPS are government-backed bonds that adjust their principal value based on inflation. As the Consumer Price Index, CPI, rises, the principal amount of TIPS increases, which means that you're receiving a higher return as inflation escalates. This makes TIPS an ideal choice for those looking to maintain their purchasing power over time. In 2026, shorter duration TIPS are particularly effective during periods when actual inflation exceeds market expectations. These bonds are less sensitive to interest rate fluctuations compared to long-term bonds, making them a more stable choice for inflation protection in uncertain economic times. By including TIPS in your investment strategy, you can effectively guard your money against inflation while earning a return that rises with the cost of living. 4. Hold commodities through specialized ETFs. Commodities have long been considered one of the best ways to hedge against inflation, and in 2026, This remains true. Raw materials like copper, lithium, and soft commodities like coffee continued to hold intrinsic value that isn't tied to the fluctuations of fiat currencies. These commodities are in high demand due to their essential roles in industries such as AI infrastructure, green energy, and food production. Instead of directly owning physical commodities, which can be difficult to manage and store, investors can gain exposure through specialized exchange-traded funds, ETFs. For example, the iShares S&P GSEI Commodity Index Trust, GSG, allows you to invest in a broad range of commodities without dealing with the complexities of buying and storing physical goods. It also provides diversification in your portfolio, ensuring that your wealth remains protected even when other asset classes are underperforming. 5. Focus on equities with pricing power. While many stocks struggle to keep up with inflation, some companies are in a unique position to thrive during these times. Those with strong pricing power. These companies are often able to pass on rising costs to consumers, thereby maintaining their profit margins and even growing their dividends. Investing in dividend aristocrats or blue-chip companies in essential sectors like healthcare, consumer staples, and utilities is an effective way to protect your money from inflation. Companies like Procter & Gamble and Coca-Cola have consistently increased their dividends for decades, even in challenging economic environments. By focusing on these high-quality companies with pricing power, you're investing in businesses that are better equipped to weather inflationary periods. 6. Explore real estate investment trusts, REITs. Real estate is another excellent hedge against inflation, and in 2026, you don't need to own property directly to benefit from this market. Real estate investment trusts, REITs, allow you to invest in a diversified portfolio of income-producing real estate assets, such as office buildings, apartments, and shopping centers, without the hassle of being a landlord. REITs tend to perform well during inflationary periods because rental rates often increase along with the cost of living. This means that the income generated from these properties typically keeps pace with inflation, providing investors with a reliable source of passive income. Additionally, REITs are usually structured to pay out a large portion of their income as dividends, making them an attractive investment for those seeking income generation. By adding REITs to your investment strategy, you can benefit from both property value appreciation and rental income. Index funds like the Vanguard Real Estate ETF VNQ provide easy access to a diversified portfolio of real estate assets, making it a powerful tool for shielding your wealth from inflation. 7. Allocate a sovereign buffer in gold or Bitcoin. Gold has long been seen as a store of value and a safe haven asset during times of inflation. In 2026, it continues to be one of the most reliable ways to protect your wealth. Experts predict that the price of gold could exceed $5,000 per ounce in the coming years, making it an essential part of any inflation hedging strategy. Bitcoin, often referred to as digital gold, is also gaining traction as a way to protect wealth from inflation. With its capped supply, Bitcoin acts as a decentralized escape from inflationary fiat systems. As more institutions and individuals adopt Bitcoin as part of their portfolio, its role in wealth preservation continues to grow. By allocating a portion of your wealth into gold or Bitcoin, you can create a sovereign buffer that helps protect your money from inflationary pressures. Both assets are seen as stores of value, and they tend to perform well during times of economic uncertainty. Whether you choose gold, Bitcoin, or a combination of both, these assets offer a powerful safeguard for your wealth. 8. Utilize international diversification. One of the best ways to protect your money from inflation is by diversifying internationally. By moving capital into foreign real estate or international exchange-traded funds, ETFs, you can reduce your exposure to domestic currency risk and take advantage of markets that are less affected by inflationary pressures in your home country. Countries like Turkey and Thailand have become popular for inflation protection in recent years due to strong domestic demand and stable usage values. International diversification allows you to spread your risk across multiple markets, ensuring that your wealth is not tied to the fortunes of a single currency or economy. In 2026, global markets offer a wide range of opportunities to protect and grow your wealth, making international diversification a key component of any inflation hedging strategy. And there you have it, 8 proven strategies to protect your wealth from inflation in 2026. By utilizing these approaches, from Series I bonds to international diversification, you can safeguard your hard-earned money and even see it grow during these inflationary times. If you found this video helpful, don't forget to hit the like button, share it with anyone who could benefit from these tips, and subscribe for more valuable insights on protecting your finances in today's economy. Thanks for watching, and I'll see you in the next video.